Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we are doing our 5 stocks with X dividends January 8th through January 12th. So I do have 5 stocks for you guys. I have Darden Restaurants, Time Warner, ABBV Inc., Cracker Barrel, and Hormel Foods. So these are 5 great stocks. I've already screened about 40 stocks. So you can see here that the screening process I did was I looked for stocks that had a price to earnings ratio less than 25, yields greater than 1.5, revenue, free cash flow, and net income all positive over the last 5 years. Or it hasn't, I'll go ahead and show you in the graph here. So we also covered the dividend dates, the price comparison to the yield, the price and earnings in comparison to the average of the industry, the payout ratio, and the dividend history, and a few other items. So if you're brand new to my channel or a recurring viewer, hit the subscribe button below. It really helps my channel out. If you enjoyed this video, hit the like button, and let's go ahead and get started. So the very first stock we're going to be starting off with is ticker symbol DRI. Now you may know some of their restaurants here. So Darden Restaurants owns and operates nearly 1,900 casual dining restaurants in the United States and Canada. It's most famous for its restaurant chains including Red Lobster, Olive Garden, Longhorn Steakhouse, the Capitol Grill, the Bahama Breeze, and Season 52. So Darden was founded back in 1968, so it's got some good history. The ex-dividend date is next Tuesday on the 9th of January. So you do need to purchase the stock on Monday or prior to be eligible for the dividend payout on the 1st of February. Now, this is a little bit of new information I decided to include on this one because normally some of the stocks they don't always have revenue, free cash flow, and net income that's positive through the last 5 years. So I decided to kind of include that here in this 5 stocks with X dividends. So you can see here that Darden Gardens as of 2013, we can see that its revenue is up 28.8%, the free cash flow is up 23.04%, and the net income has increased by 16.31% over the last 5 years. So very good growth there. And now we have our standard information here that we cover normally on our 5 stocks. So Darden Restaurants, looking at the graph here, we can see that its current stock price is $96.33. We can see as of January 2017, it's been on a very nice uphill trend. It's actually been going uphill for quite a while. You can see that there are some corrections here, but those are great buying opportunities to buy and then kind of hold or averaged into your position. They currently pay out 63 cents in dividends per share, or $2.52 per share for the entire year. We can see that the price to earnings ratio is 24.7. Their yield is sitting at 2.47%, and their price to book value right now is at a 6.02. So DRI, when charted, it shows that the current stock does have a higher price to yield, which would indicate it may be overvalued at this time. The stock is under in the industry price to earnings average. It is sitting below 60% payout ratio and has had dividend growth for 0 years. So there was a bit of a pullback at the beginning of this year. They pulled their dividend back from around 74 cents in this area here, pulled it all the way back into like the 58-cent range. After a while, they decided, you know what, we can go ahead and increase our dividend, and they bumped it back up over where they had initially pulled back from, and that kind of caused them to drop down to having 0 years of dividend growth. Their price to book value is at 6.02, which is higher than 3.0, where value investors would consider it a value. So we can see here that the price to earnings is 24.6. The industry average is 27.8. Their current dividend yield is showing 2.62. That is because they do wave back and forth depending on when you pull the information here. You can see that recently this stock jumped from a $82 stock just possibly a few weeks ago, all the way up to $96. So at this time, just kind of looking at the graph, I would definitely wait for another pullback back down into the $80 range. The dividend yield, again, 2.62, 2.47, somewhere in between there depending on the current price. Annualized payout, they pay $2.52 per share. Their payout ratio is 55.9. They did have a dividend pullback, so their dividend growth is back to 0 years. But since the time that they increased it here, from here up to here, that's an increase of 12.5%. It's actually around 2% from where they initially had it at to where it is currently at. But you can see here they've actually bumped it up. They bumped it. They declined it back in 2016. Found out they could rebump it up. So yes, okay. So 12.5% was this increase here. They increased it right around June timeframe, up to 63 cents. You can maybe expect another increase somewhere around June. The next stock is ticker symbol TWX. Now this is Time Warner. Time Warner, as you know, operates as a media and entertainment company in the United States and internationally. It operates in 5 segments: AOL, cable, filmed entertainment, networks, and publishing. The company was founded back in 1985, which is a great year, and is based in New York, New York. Time Warner is largely affected by changing consumer preferences as consumers have started to begin to move away from traditional cable to internet-based resources. So you can see like AT&T, for example, they've had a lot of people that are traditional cable guys have moved and started using their direct service. So Time Warner, their ex-dividend date is on Tuesday, which is the 9th of January once again. So you do need to buy the stock on Monday or prior to be eligible for the payout date on the 2nd of February. Again, they've had increasing free cash flow, revenue, and net income. You can see here over the past 5 years, their free cash flow has done very well. It's up 69.96% over the last 5 years. Their revenue is up 12.35%, and their net income is up 6.37% over that same time frame. They're currently paying out roughly 40 cents per share. Their stock price is at $91.93. Their current yield is at 2.19%, and their price to earnings ratio is 17.48. So we can see here that they must have increased their dividend. Okay, so they didn't increase their dividend since October. When I pulled this information, I was looking at the last time they increased their dividend here was on October of 2015. You can see here in October 2015, they increased their dividend from around 64 cents, 64. Let's see, actually it was maybe 3.4 or 3.5 something up till the 0.40, and they've continued to kind of keep this flat for the last 2 years. So if you're looking for dividend growth, this may not be the stock for you, but the data that I pulled off for it shows that they've had dividend growth for the last 9 years, just because they increased it by such a large amount during the last 2 years that it kind of balances out right around a 7% average for the last 2 years. Their price to book value is at 2.62, which is about normal or a little bit below normal where they normally sat at for the last. This chart is over a 3-year period. So Time Warner, when charted, it shows that the current stock has a higher yield to price, which would indicate it may be undervalued at this time. So here we can see that the yield currently overtook the current price. You can see that this stock was trending at nearly $100 price before falling down into the $80 price area before it hit its support and bounced back up at $91.93. So this could be a contrarian play where you could expect them to continue to kind of rebound back into the $100 area, and that could get you some quick trades. Let's see, where was I at before? The stock is under in the industry price to earnings average, sitting below 60% payout ratio, and it's had dividend growth for the last 9 years. The price to book value is at 2.62, which is lower than 3.0, where value investors would consider a value. So we can see that the stock is sitting right around a 3.7, well, I don't know where the 3 came from, a 17.48. or a 17.3. The industry is around a 22.4. I believe if we compared this one to Comcast and CenturyLink and AT&T and Verizon, it sits a little high, I believe, in comparison to some of them. I know Verizon and AT&T, one of the two was pretty high up there, but the other ones are pretty about the same. So there's that. The annualized payout is at 1.75%. They pay out $1.61 per share. Their payout ratio is very low at 26%. They've had dividend growth for 9 years, and they average around 7% increase per year. We can see that again, the last time they've increased their dividend was 14.29, and that was over 2 years ago. So they may be expected to increase their dividend again in October by, say, another 14% or 7%, somewhere between 7 and 14%, depending on the next time they plan on increasing their dividend. The next stock is called ticker symbol ABBV Inc. Now, this is a maker of pharmaceutical products. Its products line include treatments for health conditions such as rheumatoid arthritis, paralysis, Crohn's disease, HIV, low testosterone, thyroid disease, Parkinson's disease, and many others. It was a spin-off of Abbott Laboratories back in 2013. When I began initially looking at pharmaceutical companies, I had taken a look at Abbott and taken a look at AbbVie, and AbbVie is actually sitting in my portfolio. We can see that ABBV has had increase of revenue by 45% over the last 5 years. Their free cash flow is up 46.4% over the last 5 years, and their net income is up 44.21% over the last 5 years. So all this information here is over the last 5 years. You can see 2015, their free cash flow and their net income took a bit of a dive, but they rebounded very quickly within the next year and have continued to increase. I have to remove that little thingamajig there. So here we go. ABBV Inc. The AbbVie stock, when charted, it does show that the current stock has a higher price to yield, which would indicate it may be overvalued at this time. The stock is under in the industry price to earnings average. It is sitting below 60% payout ratio, and has had dividend growth for 45 years. AbbVie itself has not had dividend growth for 45 years. Again, it was a split off from Abbott, but Abbott has had dividend growth for the last 45 years. And AbbVie, because of the way it's kind of structured, they kind of took on that dividend growth. So I would see this company as a very long-term buy and hold, especially for dividend growth investors. The price to book value is currently very high at a 23.49, which is higher than 3.0, where value investors consider a value. Now, if you look at the history, this goes back 3 years. You can see that 23.49 is actually pretty low in comparison to where it may have sat 3 to 5 years ago when it first came out and when it was priced. Compared to its earnings, but it's begun to kind of continue year over year to kind of go down a little bit as they're increasing their earnings. Their price share begins to kind of balance out. They've recently took off sometime mid-year, around August, and began just kind of shooting up from the $65, $70 range all the way up now to 98.41. The dividend yield for the stock is at a 2.89%. They pay out $2.84 per share. Their payout ratio is 51.2, and they've had dividend growth for 45 years. They recently increased their dividend here. We can see that they increased their dividend. They announced it, and they increased it to 71 cents from around 63 cents. So that's an increase of 10.94%. So very healthy dividend increases and consistent. The next stock is ticker symbol CBRL. Now, CBRL Group, commonly known as a Cracker Barrel, is a chain of combined restaurants and gift stores. The Cracker Barrel's business is family and casual dining as well as retail sales. This restaurant segment drives the majority of its revenue and growth, with approximately 80% of its revenues coming from restaurant sales. Cracker Barrel has a strong brand and loyal customer base. The Cracker Barrel was established back in 1969, so it does have, again, some history. The ex-dividend date is on the 11th of January, which is Thursday. You would need to buy the stock on Wednesday or prior to be eligible for the payout date on the 5th of February. So here we go. Over the last 5 years, their net income has increased by 72.17, their free cash flow is up 56.11, and their revenue is up 10.67%. So very good growth over the last 5 years. Now this chart shows it very spiky over the last 3 years here, from from 2015 all the way now till January 2018. We can see that they're currently priced at $160.41. Their price PE ratio is 19.35. Their dividend is 2.93. They're currently paying out $1.20 per share for their stock, and they have a price to book value of 7.02. Now the Cracker Barrel, when charted, it does show that the current stock has a higher price to yield, which would indicate it may be overvalued at this time. The stock is under in the industry, the industry price to earnings average. It is sitting below 60% payout ratio, and it's had dividend growth for the last 8 years. The price to book value is at 7.02, which is higher than 3.0, where value investors would consider it a value. So the stock is sitting at a 19.2. The industry is 27.8. They pay out between a 2.93, 2.99. Depending on where you buy the stock, you could get it above a 3.0. The payout ratio again is below 60%, where I like to buy stocks sitting below 60% just in case there is a recession. They do, their earnings do pull back a little bit. They have to pay out a little bit more, and their ratio increases to say 70%. At least they can continue to have that dividend growth. Now this company has had dividend growth over the last 8 years. Their last dividend increase was only 4.35, but they do have special payouts, and these have been done over the last few years. You can see that 3 of them have been over the last 2 years, and they paid out $3 per share. That's what these spikes are here. They had little incremental increases here. You can see they went from, in the dollar range here, or 0.76, 0.78, 0.8 time to like 0.8. And they've done very minimal increases here, but they have sporadic payouts here of $3 per share. So they've done 3 of those throughout the last 2 years. So this could be a good stock. They definitely take care of their shareholders. They don't have the yield incredibly high. They don't pay out too much over 60%. They have had very nice dividend growth, and they have these special payouts. Now, number 5, we have Hormel Foods, or Hormel. It's based out of Austin, Minnesota, and it's a multinational manufacturer and marketer of consumer branded foods and meat products, many of which are among the best known and trusted in the food industry. The company leverages its extensive expertise, innovation, and high competencies in pork and turkey processing and marketing to bring quality, value-added brands to the global marketplace. So their next dividend date is again Thursday, so you do need to buy the stock on Wednesday or prior to be eligible for the payout date on the 15th of February. So this one, the revenue has only increased by about 4.75%. So their revenue has not been increasing, but check out their net income. Their net income has increased by 60.91%, and their free cash flow is up 48.56%. The fun thing I thought about this one was that they've had dividend growth for the last 51 years. So here we can see their information here. They pay out roughly 18 cents per share. They're priced at $36.36. They recently exploded down from the $31, $32 range all the way up to currently where they're at now at a $36 range. Their current dividend yield is 1.87. Their price to earnings ratio is 23.16, and they're currently trading at a price to book value of 3.9, which is about average or below for the past 5 years or past 3 years here. So Hormel, when charted, it does show the current stock has a higher yield to price right now, which would indicate the stock may be undervalued at this time. The stock is under in the industry price to earnings average. It is sitting below 60% payout ratio and has had dividend growth for 51 years. So this stock I would consider recession proof. The price to book value is at 3.9, which is higher than 3.0, where value investors would consider it a value, but it's definitely not out of the books. The stock is 23.2 price to earnings in comparison to its industry of 26.8. They pay out 2.06% of their earnings, which is roughly 75 cents per share for the entire year. The payout ratio is pretty low at 44.9, so they can definitely, they can definitely fall in earnings and still continue to pay out or increase their dividend, increasing their ratio a little bit, and that's why they've been able to continue to have dividend growth for the past 51 years. And the last time that they increased their dividend, it was over 10%, so 10.29, and it was just increased recently. So you can see here they were down in the 17-cent range. They're at the 18-cent range now. So this, I think, out of the 5 picks here, again, we have the Darden restaurants, we have Time Warner, we have ABBV Inc., we have Cracker Barrel, and we have Hormel Foods. Now, if I had to pick one of them, I'm already invested right now in ABBV. I believe my equity is pretty, where I'd like it, and I'm up at a position where I don't believe it's a great opportunity for me to currently buy in at the stock. Whereas my next pick would definitely be Hormel Foods. So let me know in the comments below if you had to pick one of these 5 stocks: Darden Restaurants, Time Warner, ABBV Inc., Cracker Barrel, Hormel Foods. Which one would you pick? And definitely, this is just kind of like a pre-screening that I kind of like to do, but definitely deep dive further and check out, check out their 10Q, their 10K. Take a read through it, see where they're getting their money from, what kind of how diverse they are in their products. Hormel Foods, they have a huge selection of products, and I'm actually looking at this one as I have so many stocks now inside my portfolio. I actually need to be thinning it down, but I think I would definitely choose Hormel Foods if I had to buy one. If you'd like to learn how to create the snowball effect, again, the link's on my website of how I'd like to do that. And that is basically it for this video. If you guys have any questions about any of the stocks that were covered, how I gathered any of the data, I do have, if you're interested in looking at the chart data, if you go to my website and just go to resources, free investing tools, I have all of this information here. As far as the Y charts here, if you click on the link, you'll go directly to the website, and it has kind of like the exact same financial metrics that I use. So I can punch in here, Verizon, and take a look at its price to book value, 8.12. I could take a look at its revenue, free cash flow, and net income, change it by percentage over the last 5 years. You can see that their free cash flow for Verizon is down 78%, so it's very quick to do the screening process on here. So that is it for this video. If you guys have any questions, go ahead and leave them in the comments. If you enjoyed the video, go ahead and like the button, subscribe to my channel. If you're a recurring viewer, hit the subscribe button. It really helps my channel, and it helps me to continue to put out new content for you guys. So that is it for this video. Thank you for tuning in, and I will see you next time. I will see you next time. Bye bye.